Markets are reacting rather negatively to some of the key takeaways from the Party Congress. There was a lot of hope going into this event that there would be support announced for the beleaguered property sector. There would be some indication of an imminent pivot from COVID zero. As it turns out, there was barely a mention of either, and if anything, it was really a doubling down on the stance there on COVID zero. So for the record, we don't actually expect any meaningful loosening in COVID zero until at least March of 2023, when we have official leadership transition. And as such, we weren't overly surprised. But as I said, hopes were very high heading into this, and those hopes were disappointed.
As you've listed, the litany of woes for China's economy and policymakers is pretty long at this point. But as Shery mentioned, none of them were really a surprise going into the Party Congress. Does it feel like with the magnitude of selling that something has changed, that investors have kind of given up, or at least for now they're saying we're not willing to even ride this out until something indicates that things will change? And what would that need to be?
It's difficult to really see a positive catalyst at this point. The one silver lining, of course, is that valuations are much improved in Chinese asset markets. But again, you need that positive catalyst to turn sentiment around. And as such, there are really few and far between. We do still think that March 2023 offers a potential inflection point. But of course, that is some ways from now. And in the meantime, global markets have a lot of uncertainty to navigate, not least of which is ongoing stagflationary dynamics and very high realized volatility, which typically suggests a much more defensive stance in terms of overall asset allocation.
You also expect a bifurcated environment when it comes to the components of inflation pressure. How do you play that bifurcation?
Again, it's really, we find that relative value globally is really regional in nature. If you look at Asia specifically, for instance, and really strip out on an economy basis, which economy is really facing the highest pressure on their central banks to tighten aggressively? That would be those economies that are facing high volatility in both their core and headline inflation. We single out Singapore as really standing out on that basis, and that has come to fruition. Meantime, other parts of ASEAN have enjoyed relatively low inflation volatility. We are actually rather positive and constructive on ASEAN versus, say, Northeast Asia within our region, and that trade has been working very well in the last 3 months.